When did your credit card become the most protective thing in your wallet, more than your insurance, more than your savings account, more than your own common sense? We are living in a moment where lawmakers and regulators are eyeing credit cards like they're the villain in a financial horror movie, ready to cap fees, restrict access, and protect consumers. Except nobody's asking what consumers get pushed toward when the cards disappear. Think of it like banning aspirin because it causes stomach aches, while leaving fentanyl on the shelf right next to it. The catalyst here is a growing political appetite to crack down on credit card interest rates. Some proposals have floated caps as low as 10%, which sounds heroic until you realize that lenders facing tighter margins simply stop issuing cards to anyone who looks remotely risky. We saw this movie in 1978 with the Marquette decision, and again after the 2009 Card Act, where tighter rules led to fewer approvals for lower income applicants almost overnight. There was a moment, not long ago, where the narrative was clean and simple. Credit cards are predatory, rates are too high, the system is broken, and reformers rode that wave with real optimism. But the data started whispering something uncomfortable. The consumers most likely to lose card access are the exact people reformers are trying to protect. The psychological tension here is real, because nobody wants to defend a product with a 24% APR and the audacity to charge you a late fee on top of it. And yet, financial researchers, like the ones at the Urban Institute, keep pointing out that cardholders, even struggling ones, have something payday loan borrowers fundamentally do not: a federal paper trail, a dispute button, and a number to call when something goes wrong. History doesn't repeat, they say, but it absolutely plagiarizes. And the pattern here is consistent across decades. Restrict one form of credit, watch demand flow downhill into whatever drain is least regulated. In the early 2000s, payday lending exploded in states that capped traditional small dollar credit. And by 2006, the military had to pass its own law to protect service members from lenders circling the financial wreckage. Buy now, pay later is the shiny new entry in this cycle, and it has quietly become the Wild West of consumer finance. No standardized disclosures, inconsistent credit reporting, and dispute resolution that sometimes amounts to email us and hope. Your credit card, for all its sins, is governed by the Fair Credit Billing Act, which means you have 60 days to dispute a charge, and the burden of proof shifts to the merchant, not you. Here's the misconception worth dismantling directly. Expensive does not mean unprotected, and cheap does not mean safe. A payday loan at 300% APR with a 2-week term and 0 dispute rights is not a better deal than a credit card at 22%. And yet millions of consumers end up there not because they prefer it, but because they had no other door open to them. The practical lesson history keeps handing us and we keep leaving on the table is that access to imperfect credit is almost always better than access to no credit or worse credit. The goal shouldn't be to eliminate the expensive option, but to make the expensive option more transparent, more competitive, and more accountable, while you build better alternatives alongside it, not instead of it. Discipline here looks like policy that expands options rather than collapses them. The actionable takeaway for you right now is to treat your credit card like the utility it actually is. Use it deliberately, pay it strategically, and document every dispute, because that paper trail is your legal armor. If you're ever tempted by a buy now, pay later plan, read the fine print on what happens in month 3 when the 0% window closes, because that's where the story gets interesting in all the wrong ways. There's a beautiful irony buried in all of this. We spent decades teaching people that credit cards were the trap, when it turns out the trap was always the thing waiting around the corner once the card was taken away. Regulation without a landing pad isn't protection. It's just a different kind of exposure. The philosophical truth here is that financial dignity isn't about having access to perfect products, because those don't exist. It's about having access to products where the rules are written down, the recourse is real, and someone is legally obligated to answer the phone. Discipline, in this context, means knowing what you have before you're told you can't have it anymore. We don't have to love the credit card industry, and candidly, nobody's asking us to, but we do have to be honest about what fills the void when it contracts. Comfort with any outcome here starts with rational preparation. Know your credit profile, know your options, and know that the least glamorous financial tool in your wallet might be doing more heavy lifting than you ever gave it credit for. And if you're ready to take the next step towards smarter financial decisions, whether that's real estate investing, home contracting work, or finding the right lenders, check out our links in the description below.